Thank you, Mala. Our next speaker, Lauren Taylor Wolfe, runs activist hedge fund Impactive Capital together with her partner Christian. Lauren serves on a bunch of boards and has been named one of the 50 leading women in hedge funds by Hedge Fund Journal. Her stock pick from last year, KBR, has steadily increased in share price even amidst funky market conditions this year. I'm excited to hear what she has for us this year. Lauren, over to you.
Thanks, Graham. It's a pleasure to be back again this year supporting such an important cause. Last year, I presented KBR, which was a high quality government services company that was misunderstood and had an accelerated yet underappreciated sustainable tech business. KBR is executing well on the value drivers that we highlighted and has outperformed the market by over 38 points, and it still remains one of our top holdings. Today, I'm pitching a name that is even more misunderstood with multiple ways to win and substantial upside value. WEX is a high quality payments company that operates across three niche and moated segments: fleet, corporate payment, and healthcare. By nature of its revenue models, it benefits in inflationary environments and it compounds earnings throughout the cycle. This high quality and resilient business has enjoyed a long track record of double digit returns on invested capital, as well as mid teens compounded earnings growth over the past 15 years. However, despite its track record of earnings growth and returns, today WEX trades at its lowest multiple in roughly a decade, trading at 13 times earnings versus its 10-year average of closer to 20 times earnings. This is driven by market fears over new entrants, primarily in the smaller corporate payment segment, as well as a fear over unit economics as battery electric vehicles enter corporate fleets. I'll address both of these concerns shortly. Of WEX's three segments, on a normalized basis, the fleet segment contributes about two-thirds of EBITDA, corporate payments contributes about mid-teens EBITDA, with health contributing about 20% of forward EBITDA. The fleet segment is WEX's largest, where it operates a closed-loop network in a duopolistic end market with pricing power and enjoys attractive margins. They have a powerful network effect as WEX sits between 17 million vehicles on its customer fleets on one side of the network and about 95% of the fueling and charging stations in the US on the other side of the network. WEX negotiates favorable pricing for their fleet customers and offers value-added services like fraud prevention, credit, reporting, fleet telematics, and in the future, a host of electric vehicle data and subscription services. Now, the fleet segment has a multi-decade track record of double-digit top and bottom line growth throughout cycles. It's worth noting that after 2016, they have less fuel price exposure because they restructured pricing on fleet contracts and made an over-the-road focused acquisition in EFS. Today, more than half the segment revenues are fixed in nature, creating a higher quality earning stream. One driver of the recent multiple compression is the market fears over the uncertainty in unit economics of battery electric vehicles as more EVs enter corporate fleets. Now, while we don't know the pace of EV penetration of the fleet, what we do know is that it's coming over the next decade or so. The market's perception is that WEX has a limited path forward in an EV world. However, our proprietary research suggests just the opposite. WEX sits in a pole position with access to data and analytics that will drive substantially greater economics per vehicle. New innovative subscription products and pricing power will drive higher quality recurring revenue streams, potentially more than doubling unit economics. Now, underpinning our views here is substantial market research, including a survey of over 100 fleet managers representing tens of thousands of vehicles. As we transition to more EVs and a hybrid fleet, the need for a central provider of payments reporting, credit, telematics, fuel efficiency and carbon emission offsets calculations, and electricity pricing optimization will be increasingly critical. Looking out over the next 3 years, we expect the fleet segment to continue to compound EBITDA in the high single digits. This is a high quality, moated business that performs very well in inflationary environment. So applying a 13 times EV to EBITDA on our 2025 estimate of EBITDA less stock comp, we arrive about $9 billion of value. That's currently the entire enterprise value of WEX today, which implies we're getting the next two segments for free. The second segment is the corporate payments segment, comprising about a mid-teens percentage of normalized profitability. WEX is a leading provider of virtual payment cards to online travel agencies, automated corporate payments in the B2B space, and accounts payable processing. They help companies manage and settle transactions digitally across the globe. In a normalized environment, this segment grows a healthy double-digit top and bottom line. However, the travel business, which provides virtual cards for cross-border travel at hotels, has been significantly impaired by the pandemic and is still in the process of reverting back. Today, we're investing at a depressed moment in leisure travel, and so the reversion to normal, in addition to the healthy double-digit corporate payments growth, will drive about 20% EBITDA CAGR over the next 3 years. Now, another key driver of the recent multiple compression at WEX, despite consistently strong results, has been the fear of new fintech entrants and a flood of new payment IPOs in 2021. The left-hand pie chart on this slide illustrates the $36 trillion business-to-consumer total addressable market. WEX does not compete here. This is where the vast majority of these new entrants operate and in an already digitized B2C space. The right-hand pie chart represents the $24 trillion business-to-business TAM, where WEX does focus. Within the B2B TAM, WEX competes primarily in a niche $400 billion virtual card space that's represented by that little teal slice on the slide. Here, WEX overlaps with only a handful of players. It dominates the travel market with about 80% share in the OTA hotel business and is the leading provider of automatic corporate payment solutions. There is a long runway for double-digit growth in this market since well under 5% of B2B volumes are currently processed with a virtual card. We expect this business to compound at a healthy double digits over the next 3 years as we see the recovery in cross-border travel and a continued secular shift away from cash and checks to digitized corporate payments. At 14 times EV to EBITDA on EBITDAless.com, we estimate that this segment is worth about $3 billion, or roughly 30% of the current enterprise value. Now, WEX's final segment, the health segment, manages consumer-funded healthcare products such as health savings accounts and flexible savings accounts. This is a recession-resilient, secularly growing business that enjoys dominant market share, high switching costs, high retention, and a high moat from handling sensitive health data. WEX's Health has grown the top line 27% and EBITDA about 37% over the past 8 years, driven by high teens organic growth in consumer-funded healthcare and complemented by M&A. Organic growth here is underpinned by consistently rising healthcare costs, which has driven more employers to offer these benefits, and it's also been driven by Congress's consistently expanding the scope of these plans' applicability. About 2/3 of the health revenues are linked to recurring SaaS contracts, making this WEX's highest quality business, enjoying over 95% revenue retention. Now, importantly, this is a value-added service which helps corporate employers use pre-tax dollars to access healthcare and ultimately drive superior health outcomes. Increasingly, more employers recognize HSAs and FSAs as key tools to attract and retain a skilled workforce while simultaneously reducing their own healthcare expenses. We view this segment as the underappreciated jewel within the WEX enterprise. It competes mainly with Allegis, which is owned by private equity firm Vista, and pure play public peer Health Equity. At WEX's current multiple, the health segment trades at an implied 70% discount to the public peer Health Equity. Alternatively put, if we valued WEX Health at Health Equity's multiples, it would be worth roughly half WEX's entire enterprise value today. That said, we don't need a 30 times EV to EBITDA multiple like their closest peer to drive attractive returns. At half of that multiple, at about 16 times EBITDAless.com, we see a valuation of over $3.5 billion on WEX Health by 2025. So when we consolidate the three segments in our 2025 base case sum of the parts value, we see 100% upside from today's share price, which implies a reasonable 17 times PE multiple on 2025 earnings, which is still a 3-turn discount to where WEX has traded historically over the last decade. Now, at Impactive, our investment strategy is about helping companies allocate capital to accelerate long-term sustainable returns. For WEX, we see multiple levers to drive further value creation, given the highly profitable and free cash flow generative nature of this business. We lay out 3 key opportunities for long-term value creation. Firstly, WEX can unlock value by investing in the right electric vehicle products. Our work suggests that customers are demanding reporting, data, and analytics that may drive over 70% more revenue per vehicle in an EV world. On the incremental 17 million vehicles in their fleet today, if we switch them to electric vehicles, this would mean an incremental $1 billion in revenue for WEX. Further, over the next 3 years, WEX will generate, in our base case, about $2.2 billion in free cash flow. This, coupled with an incremental $2.3 billion of debt capacity, implies a total of $4.5 billion of capital available to deploy. That's 60% of their current market cap. If WEX deploys this capital entirely to share repurchases, they'll generate about $23 a share in earnings by 2026. That's over 250% higher than earnings in 2021 and implies a compounded rate of 25%. If we apply their 10-year average multiple, which is less than a 1 PEG ratio, that's about $460 a share, almost 3 times the current share price. Now, we could alternatively use the substantial free cash flow generation to make accretive acquisitions. Private and public market valuations are coming back down to earth. Many payment companies are in need of cash, and we expect that highly free cash flow generative buyers like WEX to be in a position to pounce on M&A opportunities in coming quarters and years. The company should obviously only do M&A to the extent that it's more accretive than share repurchases that we've outlined in the prior slide. So we view this $23 a share as a floor, not a ceiling, in the company's earnings per share potential. With stronger segment growth, including from the investments we've laid out, as well as execution on the operational plan and capital alternatives that we've laid out, we see the potential for an upside share price of close to $500 per share by 2025, which would be a triple from here. So to sum it all up, we see an extremely attractive asymmetric risk reward over our 3-year time horizon, which is why WEX remains one of our highest convictions names. Thank you, Graham, and the Sohn Foundation. It's a pleasure to be here, and hope everyone enjoys the rest of your day.